So after a sour end to the week last week, we kind of recovered a little bit of it today, we started off with your typical bounce, oversold bounce, so to speak, that we've seen in the past. So now what I'm going to do today in today's video is I'm going to break down whether or not this bounce pretty much erases what we covered in Friday's video, or whether or not today was the anomaly and we still have the expectations of what we talked about Friday. And then I'll continue to show you today with the different technical, even more signals today added to what we saw on Friday that would suggest, the possibility of an actual pullback occurring. So I'm going to break all that down. We're going to take a look at the moves today, and especially in some of these other markets that made some interesting moves. But also suggest whether or not the pullback that we anticipate could be worse than that. So I'm going to break that down, and then our trade idea today in a stock that's already had its pullback towards support that we anticipate the rest of the market to have. So we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, June the 29th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Same as Friday, we continue to have this light pink shading yellow line pattern, which is actually a bullish pattern typically. You notice we are still between the 0 and 23% lines. We haven't broken that support yet. So technically, this just would continue to be considered noise, right? We don't start a pullback until you break the 23% level. So in other words, until you've retraced at least a quarter of the previous move, it's not really a pull. So we still haven't retraced a quarter of the previous move. Again, it's a function of how big that move was. So don't get wrapped up into the size of these moves, because it's all in context, and it all goes back to this drop. Right? Since the drop, everything's been bigger. The VIX is a bit higher. Everything is just bigger. That's just the nature of the moves right now. The intermediate line, however, continues to push down below the market sentiment line. We talked about Friday about how that's not necessarily the most bullish sign, and that continues to be the case here. Short-term sentiment bounced up. Not surprisingly, the momentum line, when it's extremely low like this, tends to bounce. So it bounced. But the near-term line didn't bounce up very much. It's still actually below the 50th percentile, so it's not the strongest short-term sentiment. It actually is an inside day. It's a Harami pattern here. We'll see if that plays out into a reversal to the upside or not. Again, like I said, that's a bullish pattern. We are still above the 23% line. If we do bounce up, I wouldn't expect this, maybe a week or two of bullishness, but I wouldn't expect a lot. Because of the nature of this decline on the intermediate line, and the fact that we've been bullish. The intermediate line's been, it's been since April, so we're going on now a third month. We're almost done with the third month of being of this strong bullish intermediate posture of dark green shading and light pink shading. Right, that's a bullish trend. It doesn't break until you get the dark pink shading in the red line. The Russell 2000 had an even better jump. It bounced back up above the 30-day moving average. Its short-term sentiment looked a little bit better, though the near-term line stayed down. And then you take a look at the Nasdaq, which wasn't nearly as bullish, and but it has been so much bullish, so much stronger in its bullishness that its intermediate line is actually still above 80. So it still hasn't gotten the light pink shading here like everything else. And the near-term line itself is coming up off of a strong bullish low point. This is an intermediate confirmation signal that we bounced off of. So now the question is this one-day little bullishness today going to lead to like a week or two? My expectations are they won't. That this one day is, we'll still continue to push down towards the 23% line here on the Nasdaq, which most likely would mean a breakdown to the 38% level on the S&P, as well as on the Russell, which got back above the 23%, but it's been up and down around that level for the past 4 days. So a move down to the 38 on this and on the S&P would most likely coincide with a drop to the 23 on the on the Nasdaq, that would give us intermediate pullbacks on the S&P. So most likely the intermediate lines will pull down below 50 on these two indexes, something like this, and then we'll just bounce off. I expect that we'll bounce off this 38% line and work our way back to the upside again. We'll see if that ends up being the case, but that's my expectation going forward from here. Now, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here. There it is. In the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video here if you're watching us on YouTube. That will notify you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you want us to do a video again tomorrow. If you want to let us know that, then you can do so with one click right now while you're watching. If you don't like our videos, you don't have to click on anything, right? It's really simple. You don't even have to watch our videos if you don't like them. So also, too, comment. What questions or comments do you have about anything we talked about today? And let's keep this conversation going down in our comment section below. Join our website at marketscholars.com. There's a link popping up right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content. In between the videos, my handle is up there, wherever, at DavidSettle42. And then also join our Market Outlook Facebook group that we've created. If you're watching us here on our website, check out some of these other links over here on the right. You can see the Market Outlook live. Whenever I do the Market Outlooks like I'm doing today, I always do a live trade review video at 3:30 Eastern Time on the same day, and you can see those here by clicking on this link. Here's our upcoming trading rooms that we have. Again, if you get access to all of these when you subscribe to our monthly plan. Our premium subscribers, so our monthly is our plus plan. Our premium subscribers get access to all those things as well, in addition to our weekly online coaching, group online coaching sessions, and our premium tools, as well as access to our community, there. Engage with us here on social media. Click on this heart. It opens up a new window. Hit that like button right there. Also, click this thumbs up. It opens up to your Facebook page, and you can click on this like button here as well. Appreciate the comments there. Really appreciate the comments there. Again, the more you do that, the more that benefits us, because it will promote our content to all of our followers, with the more likes that they have. Also, it benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's take a look at the candle here, and you can see it's a little bit of a bearish candle. Again, it's a small candle, and it's a very small range compared to what we've seen these last 2 weeks so far. But these are a couple of transition candles, and as of right now, this is a bearish weekly candle. Now, if we bounce up here, there will be another transition candle. So it's not like this is automatically going to finish the week bearish. Keep in mind that this is a short week, so there's still only 3 days left before the weekly candle. But we still have positive momentum. It's rising. So any weakness again that we get down to the 38, even if it comes to the 38, it's not going to be the end of the world. It will be back below the 200-day moving average, because the 200-day moving average is sitting at the 23% level. But because of that, I don't expect it to last very long, because we can get right back above. It's probably something similar to what we saw here. You came down. This is probably the worst case scenario, where you came down and stayed below the 200 after getting above it, stayed below it for a few weeks before starting a new trend. That's probably our worst case scenario. Our best case scenario is probably a pretty decent sized dip to the 38. And that's it, right? And then we might hover around 38 and 23 for a few weeks, like 2015, before we get going again. And there's that trend line that we had drawn before. You see this upward trend line here. You can see we're above that, so you would look for some support to get back up above that line relatively quickly. So again, that wouldn't be the end of the world, but that's kind of what I'm expecting to see happen here. If you take a look at the 3 green arrow chart, we don't have 3 green arrows. We actually still have 3 red arrows, and we're actually lower than we were the last time. But again, still holding that level. If you take a look at how we finished today, we are still below the 8-day moving average, which is crazy. That was an update. You don't think that, but we've been below the 8-day moving average since this drop on last Wednesday, and we talked about how important it was to get back above the 17-day within a day or two, and we didn't. We got above the 30, but we didn't get back above the 8 or the 17. We're still below the 8, and even with today's rally, we're still below the 8. So the MACD and stochastics are both falling below the moving averages. So don't get too worked up with this bounce, right? There's still a more than likely chance that we'll break this 300 level and work our way down towards that 38% retracement. Again, RSI, and CCI, when you look at those two, you can see, we're flirting with the midpoint here at 50. We're in the lower half of the chart. We've been in the lower half of the chart here for a little bit of time. So this kind of shows, that we're not like falling off a cliff bearish, but we're also not really bullish either. We would be back up. We'd be easily above 50 if that were the case. Above 60, ideally, something similar to this. We'd be above 0. The Ichimoku cloud is telling us, that we're in a noisy pattern right now, which makes sense because when you're going up and down between 0 and 23%, you're in a noisy pattern. But we are, we're below the blue line, and we have been for a few days. But we're still above the cloud. So, and you can see if we pull down to the 38%, we'll essentially pull down to the top of the cloud. So you can kind of get an idea of how easy it will be to pull back, and how that pullback will be nothing more than that. It wouldn't necessarily. Now, that won't be the case on Twitter or on TV. They'll be talking about how, how we're about, are we gonna now retest those lows, but the reality is it's just going to be a pullback, and my expectation would be nothing more than that. So, for example, again, on the Bollinger Band, you can see, that we're holding the point of control now at the 23% line. That's why it's not like breaking through like a rock, right? There's a strong support here. And if we do break that, if we break that 38, then we can move down to the 62. Between 38 and 62, you can move pretty quickly and easily. It's like the 0 to 23. It's that way between 38 and 62. So if we can hold that, great. If we don't, and you can see that's where the bottom of the volume node is. So that's where all the action has been. That's the expectation. And you can see now, again, the bandwidth with the rally today got back up above that 25% line, but we'll see if that's a one-day anomaly, and if we get back below the 25 tomorrow, then that will kind of confirm what we're talking about here with this move. The DMI also, too, the thing that stands out today is we did drop below the 20 line. So yesterday we were sitting at 20. Today we had dropped below 20, and if we bounce up, great, but when you drop below 20, that's when the intermediate pullbacks. That's kind of a sign of an intermediate pullback. So we have already crossed above 30 here, but it's that positive dropping below 20. That's usually the sign that we're not just getting a little 23% retracement, that we're more than likely going to get down to that 38%. So we'll see if that bounces back up tomorrow or not, and if it stays down again. Getting back above the 17 quickly, getting above this 20 quickly, that's key. If we don't, retracement, right? Retracement levels. All right, let's take a look at the intraday chart here. And you'll see the little rally we had got us basically back up to the node here. There's a 23% line. There's resistance here. So it's not like, if we feel this, we can get to that 311 pretty quickly, and that will actually be pretty nice. Probably a pretty decent chance at 311 here. That we will be, if we can get back up to that 311 area, we'll be back above the 8 and 17 day, and that will kind of say, okay, then we're going to be bullish for another week or two. We haven't had the pullback yet. We'll move back up towards that 0% level, and we'll be bullish for another week or two. If we don't, if this little short-term intraday resistance holds, then we'll probably continue lower. Again, not be a bad thing, right? It'll just be kind of the nature of the beast, so to speak. Our volume is at low. The trading range today was below average. So, we're hardly falling off a cliff, and nor should we ever expect that we would. But we still have a high ATR to price ratio, still above 2%. The volumes are still relatively high, and they're kind of moving slightly higher. The other thing, too, is the VIX is still not above 100%. So, so if we are going to get an intermediate pullback, you'll see a jump in volatility. So don't be surprised. Getting up to 105 like we did here a couple weeks ago, that's typical of an intermediate pullback. So, we're pretty muted here, but which again tells us, don't worry. Any weakness will just be a pullback and nothing more. But it also tells us that, if we break down towards 90, then we're going to get another week or two of bullishness, right? Until we flirt with this level again and then make our pop up to the upside in volatility. So that's on the table. I think that's a lower probability scenario that we maintain, a week or two more of bullishness here before we get ultimately a bigger than 25% retracement pullback. I think the higher likelihood is we'll probably start that process either by the end of this week, if not by next week. All right, so before we talk about different markets and then our trade idea, I do want to kind of summarize. So we have a bullish posture. We've been on a strong bullish trend. We've been gradually showing some weakness, and the last couple of trading sessions, we're showing more signs that this weakness will turn out to be more than just noise, that it will turn out to actually be a pullback. And it won't be that big of a deal, right? There's strong support at the 38%. It'll be a nice, healthy pullback that will give us a better low point to maintain a new intermediate run off of than what this one would be if we were to bounce up right now. Right now we might get a week or two, whereas if we can get down to the 38% and hold that and bounce off of that, then we might get a month to 3 of new intermediate runs. So heading into then potentially a period of volatility surrounding the election. So what do you think? Do you agree with that assessment? Do you disagree? Let me know down in the comment section below, especially if you disagree. Share with us what you're seeing that suggests either that you're a lot more bullish than that, or that maybe this is all the weakness that we're going to get, or that you're a lot more bearish, that we're not just dropping to the 38%, that we're going a lot further down. If there's something that drives that opinion, because everybody's got their opinions, right? But if there's something that drives that opinion, then share that with our community down in the comment section. All right, if you take a look at the action today, look at the small cap bounce. I mean, so this is really what it was today. It was a oversold. Small cap stocks were very oversold. In fact, if I share this chart with you that I've shared with you before, you can see how much. So this is QQQ relative to IWM. You see how much since June 8th that we bounced up. I mean, that's a big bounce up in the ratio here off of that June 8th low point. So that's an oversold bounce. More than likely that means that we're, that we just got an oversold. For the IWM, is just an oversold technical bounce today. Really nothing. I wouldn't get too, again, worked up in the bullishness of that. It was nice to see commodities do a little bit better as a whole. You also see real estate. So you had some physical commodities. So these are all kind of economic related, right? Small cap S&P is not nearly as economic related to the economy as a whole as IWM is. And then, of course, commodities and real estate are tangible assets. You can see the dollar and gold are both flat. Long-term bonds were down, so a little bit of a risk-on move. And then high yield was also down, which is not really what you'd expect on a risk-on day. So it's a little bit of a concern if you take a look at, let me go back to this chart. Let me take a look at how high yield has been doing relative to treasuries, long-term treasuries as an alternative. And you can see how we've the relative strength has come back down here. Let me give you a little bit more perspective. We'll go back a couple of years to give you some more perspective on this chart. You can see how bearish we were at the beginning of the year. High yield really dropped down, and it's poised to do that again. So we'll see. It's like it broke below the 50-day on Friday. It stayed down. The MACD is going back negative. The PPO looks like it's rolling over as well. So again, that's a little bit of a concern in terms of risk appetite, right? You wouldn't expect that. Now, if we stay down here and maybe diverge or something, or form a higher low point, then you can see that happening on any kind of intermediate pullback, right? Where so we kind of keep an eye on that and see if we come down and form a much higher low point on the MACD, and then obviously a higher low on this kind of something like this, where you go down and then up a little and then down just a little bit. So something like, again, something almost exactly like this, bigger drop than what you had here, but you make a run above the 50, you come down, and then you start your trend up to the upside. That's kind of what I'm looking to see happen here, that during any kind of intermediate weakness, we continue to act down below the 50, but not to a lower low, probably not even all the way down to these lows, more than likely down towards this 48, 47 area, then turn around and get things going again after a little bit of brief, few weeks maybe of weakness. Of course, the other thing that's really standing out is the dollar. So if I were to look again at the UUP, which has been on this bearish trend, you can see now we got light green shading again, but we still have a red line. We're still below the 38% Fibonacci retracement of this intermediate drop that we've been in. So we're not breaking resistance yet. And even if we do, we might go up to the 62 into the 50, 62 area. So we'll see how far up we go into that retracement zone between 38 and 62. But as of right now, we're holding it. But if we get any kind of weakness, we might kind of hammer around here for a while before we roll back over. And again, the long-term chart remains pretty bearish. We're just really, we're down quite a bit below the 50, and we just barely, or excuse me, the 30-week moving average, we just barely dropped below it. So it's not surprising when you barely drop below it that you don't make a little bit of a retest back up to the upside. So when you get the death cross, so you make a little bit of a retest towards the 5200 before we continue the trend lower, which again is the expectation, which would coincide after a period of short-term weakness here and a quote-unquote pullback where the dollar continues its way to the downside. And that's typically pretty bullish for the risk trade. Let's take a quick look at yields today. So the 10-year yield specifically, and you can see down again and almost to a cluster. So, just it kind of shows you just how oversold we are again on the yields and how overbought we are on long-term bonds. Not quite the cluster yet, but you can see a little bit of a intermediate confirmation signal playing out, and kind of keep an eye on that near-term line. But, I expect that, getting back above this 23% line, I expect that bonds will continue to push up towards this area, and yields will continue to show some weakness. But not for too long. Again, we talked about the commodity basket and see how bullish it is. We got light pink shading here because we've had a little bit of decline, but it's got a lot of room to run to the upside. Big gap. So if we break through this area, we might pull back a little bit, maybe into this volume node, 38% retracement. But then again, if it breaks through that node, then that's why I say we can get another good 1 to 3 month run on the risk trade, because there's still a path of least resistance here, as well as in equities. All right, now let's look at how the sectors performed today. So let's come down here, and you can see how energy has been pulling back, and all the cyclical names are up here along with materials. Let's take a look at just today. So bear with me 1 second while I get to just today's chart. 10 minutes. Okay, you can see industrials had a great run. A lot of it's Boeing here, but industrials had a good run today. You can see technology lagging, healthcare lagging, financial still lagging after their bad day on Friday. Whereas you have materials, materials, staples started off the day strong, finished relatively. You had a bunch of things finish above the market here. Real estate kind of worked its way into that spot, discretionary. So you can kind of see your main cyclical areas, technology and communication services that have been the big winners. They're lagging here. And again, it's one thing for them to lag on up days like this, because you get these beaten up sectors that will oversold bounces, like we saw with IWM. But it's another thing to see them lagging on down days, and that's when we know things are a lot worse than just a pullback. So as of right now, during the pullbacks, during the rallies here, you have small caps and industrials, and to a degree financials. Financials just started good, and energy started good, and industrial. I mean, this was your typical rally lately. When small caps in these areas rally, the problem is that financials really and energy really struggled after that move. Stocks kind of did too as a whole, but they really struggled there. But industrials didn't. Industrials really held up much better. So, again, look at the 12 grid for these sectors, and again, there's your leadership up here, and they're still showing. At worst, light pink shading and yellow lines, which are all pretty bullish. We've got some dark pink shadings and yellow lines on some of these, as well as, on healthcare now, red line and dark pink shading. So, there's some weakness in here, and we might end up getting this light pink shading and yellow lines, because we dropped so far. In this case, like communication services and for that matter financials, we're kind of dipping energy here, kind of dipping a little bit below the 30-day. So there's a good chance that the yellow line turns into a red line while we have this dark pink shading, especially with energy down at 23. Technology is the only intermediate, dark green that we have. Everything else is below 70. Some of these below 60, and you can see we have a few that are all below 40, which means kind of it's more of a bearish move. So it looks like that these kind of areas are signaling where some of these others will end up getting to as well. All right, with this weakness, you're finally getting some of these areas where we're getting some pullbacks that it can lead to something, to a little bit of a bounce. Whether or not it bounces now or for a few weeks, or whether or not it may take a week or two, or some areas bounce more than others. But Lockheed, during this rally, Lockheed Martin, you can see, has been relatively bearish, to the point where it's had light pink shading and a light pink or dark pink shading and a red line. If you look at its pullback that we had here off of that low all the way up to this high point, you see that we got to the 38% retracement again, held it so far, holding it for support. You look on its Bollinger Bands too, and you can see how that's the bottom of the value area as well. And you look at its histogram on the MACD and stochastics, and you see an opportunity for a little bit of a pullback. You've got the histogram turning up, flirting with the 8-day moving average here that we finally got up to. The MACD and the stochastics both turned up, even though stochastics still oversold, but it's close to crossing above its moving average. And again, like I said, the MACD is turned up and its histogram. So you got some positive signs here. You look at like the RSI and the CCI. The RSI kind of flirted with breaking below 40, something similar to here, and now it's bouncing back up above it. And same thing with this little bullish divergence here. We got higher lows with lower lows coming into support. So you got some opportunities for us to bounce off of this. And one thing that's interesting about when you look at the DMI chart for Lockheed is last time we dipped to the 38% over here, to this level at least. It wasn't the 38% line at the time, because if you notice, if I activate this to this high point, well, I guess it was pretty close to the 38% there on that pullback, and then now just a little bit below it. But last time you can see the negative directional index was just barely above 25, and we dipped below 20 on the positive. We actually been flirting with dipping below the 20 all day today. That's why it kind of stood out to me. But the negative is a lot higher, which means if we bounce off of here, there's a lot more room to go up for the stock, according to how high the negative directional index is now, versus back here where we went up that much and the negative directional index was already below 25 for the most part. So there's opportunity to make a decent run on this stock because of how more bearish it had been than what we had seen previously. Again, if we end up bouncing. If we don't bounce and we break the support, then there's a pretty good chance that we just kind of really break down, because there's literally no support on the 1-year chart here, but it's only this level here. So if we break down and retest these lows, we're retesting those lows. So it gives us an opportunity to say, okay, I can take a small risk because it's going to be obvious when it breaks to the downside, for a pretty decent reward potential, knowing that that's how much we went up last time, and we have more potential to go up this time than what we did last time. So that opens up a trade for, again, and we also have earnings coming up here in July. So you can say, okay, well, if I take a look at the August cycle here and take a look at the $400 strike and the $395, again, it's a relatively wide spread. It's, you have to kind of fiddle with this spread to get in, to get into this. But if you analyze this trade, and this is where we're at here, I've already got this trade up there, then you can see I've got kind of a normal position size, and you have to keep in mind it's a wide spread. So you might not, you want a position size even smaller than normal, even for your directional option trades, which you position size smaller than normal for the high probability, because of the risk factor for the earnings you have to account for, the risk factor of it being a low probability directional trade, which we do by cutting it in half right? Then we add on the earnings, and we also add on the wider spread, which makes it likely that we end up getting out in the worst case scenario at the maximum loss. So we'll just keep that down to a few $100 there, and for that few $100 of reward, we get about a 3-to-1 reward to risk ratio, which is kind of what we want to see and get from a directional opportunity. So it's relatively high, and you can see the maximum gains easily inside of the 1 standard deviation move because of that earnings. So we have a relatively higher probability directional trade here that we can easily manage the risk for if we break down below that support and potentially even keep our loss to a couple $100 or less if we were to break that support relatively quickly, and we see that it's not going to move, and for a couple $100 now, $1,000+ is a pretty decent reward to risk ratio. All right, well, that wraps us up for today. So you've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. Goes to our website, goes to our forums. You actually get access with your free account. You get access to our Market Outlook forum in our community on our site. So you can open up any new thread and reply to anybody else's thread. And let's keep this conversation of what we talked about here in the video going. Any questions or comments you have about anything even we didn't talk about, you can post in there as well and reply to anybody else's thread too. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video below. Follow me on Twitter at DavidSettle42 for more content between the videos, and join our community at Market Scholars as well as our Facebook group that we've created. Have a great rest of your Monday night, everybody, and we'll see you all next time.